So today I will be discussing the invincible hand sometimes shakes commodity cycles. So up to now, the focus has been models of individual firms where market forces, the feedback between the price, demand, and supply were omitted. So these supply chain models tend to oscillate in response to shocks. So, do market forces attenuate or amplify such oscillations? Many industries experience chronic cyclical instability. Most commodities, whether animal, vegetables, or mineral, experience cycles in price and production with characteristic periods, amplitudes, and bases. Industries with long construction delays and long asset lifetimes, such as shipbuilding, paper, chemicals, and real estate, likewise exhibit strong cyclical dynamics. Even services industries such as insurance exhibit characteristic cycles in price, profitability, and investment. So commodity cycles. So commodities in mineral products such as copper, iron, and mercury, forest products, lumber, pulp, and paper, and in agricultural products, coffee, cocoa, and cattle. So what is commodity cycles? A very common explanation of commodity cycle is that demand is cyclical. It is true that the overall economy rises and falls with the business cycle, and this movement induces some corresponding fluctuations in commodity market. And also commodity cycles are not arise only in raw material and agricultural product, but also in high tech and high differentiated product. So this is the example of the high tech and high differentiated product. So this figure, the commercial aircraft orders and production. So the worldwide aircraft orders annual growth rate is in orders for commercial aircraft. So for example, jets is equal to 50 greater than or equal to 50 seats, and then the air travel, it is the revenue passenger kilometer per year, and then the GDP weighted by each region's share world air travel. So as you can see, this figure shows the demand for aircraft exhibits a large amplitude cycle roughly for 10 years. So the generic commodity market model. This figure shows the underlying feedback structure responsible for commodity cycles. So this figure shows the stock and flow structure of the commodity production and the perceptual and administrative delays in the main behavioral decision process. So the stock and flow structure for production and inventory is at the top of this diagram. So here, so this represents the supply chain for the commodity. So on the demand side, the demand for any commodity depends on its price to substitutes, the number and purchasing power, and the social and technical factors. So social and technical factors such as the trend of the low-fat diet that might reduce the beef consumption. So in substitution loop B1, so high prices reduce the relative value of the commodity, causing the demand to fall. So here in B3, the balancing capacity utilization loop. So this is the supply side. So higher prices leads to higher utilization of the existing capacity. So while both utilization and capacity acquisition respond to price, this decision differ in important ways. So the utilization decision responds to the expected profitability of the current operation. So the expected profitability of new investment, in contrast, depends on the total cost of the new capacity and both fixed and variable costs, and on investors' forecast of what price will be over over the long term. So note that also in this balancing availability loop, so this limits the consumption whenever inventory is inadequate. So in many markets, prices, demand, and production usually adjust quickly enough to prevent shortages, but market do not always clear by price alone. So availability often plays a large role in balancing consumption with production. So shortages and are experienced a lengthening delivery delays that products placed on allocation or simply stock outs. So the so even in commodity markets where prices normally adjust rapidly, extreme conditions such as price controls or a run of panic buying can overwhelm the price feedbacks and force shipment below to enter the market. The substitution, capacity utilization, and capacity acquisition loops are involved. These all loops involve of different types of delays and may therefore cause instability and oscillation. So if the production delays are long enough, oscillation may arise as capacity utilization adjusts in response to change of price. So the delays in capacity acquisition feedback are much longer and also may produce even large cycles. So both supply side loops include physical delays and information, perception, and the decision making delays. So next is the production and inventory. So to move from the conceptual model in the last figure, so now let's move to the formal model. Begin with the supply chain for production. So stock and flow chain formulated as and inventory is equal to the um, integral of the production rate and the shipment rate. So shipment is equals to the desired shipment rate times the order fulfillment ratio. So shipments are determined by, of course, the customer orders and the order fulfillment ratio. So the order fulfillment ratio is the function of the maximum shipment rate over the desired shipment rate, while maximum shipment rate is equals to the inventory over the minimum order processing time, and then desired shipment rate is equal also to customer orders. So here, production is modeled as delay. So a third order delay. So production rate is equals to the third order delay of the production start rate and the manufacturing cycle time. So this production start rate is equals to the production capacity times the capacity utilization. Capacity utilization. So utilization depends on producers' expectations regarding the current profitability of operations. It also responds to inventory and backlog levels. Production in many commodities is constrained by available storage capacity. When storage capacity is approached, production must be cut back even if profitability remains high. Shortages will lead to increased utilization at any given level of profitability. So utilization cannot generally be changed immediately. So it takes time for producers to gather data on cost and profitability. But even when data are available, it takes time to filter out the noise and detect changes in trend. So for simplicity, um, the delays in the adjustment utilization to the desired level is formulated as first order exponential smoothing. So capacity utilization is equal to the smooth of the indicated capacity utilization and then utilization adjustment time. So where utilization adjustment time aggregates the data collection, decision making, and implementation of delays. While the indicated capacity utilization, it depends on the um, expected profitability of operations indicated by the expected markup ratio. So indicated capacity utilization is equal to the function of the expected markup ratio. And this expected markup ratio is equals to short run expected price over the expected variable cost. So this figure on the right side shows that the utilization is greater than 0. So even when the average expected markup ratio is less than 1, so when the markup uh, is low, only the most efficient plants and the producers with the most optimistic expectations find it worthwhile to operate. So as expected markup ratio rises, so more and more producers believe their capacity can be operated profitability, and utilization also rises rapidly. So once most of the facilities have been recruited in the production, so further increase in expected markup ratio yield diminishing returns until utilization saturates 100%. So the next one is the production capacity. So each production unit corresponds to the amount of the plant and equipment needed to produce 1 unit and output per year. So the productivity of capacity is for now constant. The rate of output generated to fulfillment utilization by the existing plant and equipment. So the supply chain for capacity assumes a first order discard process and the third order capacity acquisition delay. So the capacity acquisition delay and average life of capacity are assumed constant. So the stocks are initialized to their equilibrium values. So here production capacity is equals to the capital stock times the capital productivity. So capital stock is equals to the integral of the acquisition rate minus the discard rate of the capital stock. So capital stock is equals to the reference demand over the capacity utilization over the capacity productivity. So discard rate is equal to the capital stock and the average life of capacity. So acquisition rate is equals to the third delay on or third delay on order rate capacity acquisition delay. So capacity on order is equals to the integral of the order rate um, minus the acquisition rate of the capital on order. So capital on order is equals to the discard rate times the capital acquisition delay. So the order rate is formulated with a standard management structure. So orders are constrained to be non-negative. So for now, no order cancellations are allowed. So this explains the equation here. So the indicated order rate is the desired acquisition rate adjusted by the adequacy of the supply line. So producers seek to correct the gap between the desired and the actual supply line over the supply line adjustment time. So here, so the desired capacity line is the amount of the capital firms must have on order and under construction to yield the desired acquisition rate. So for simplicity, expected acquisition delay is equal to the capacity acquisition delay. So the desired acquisition rate in turn consists of the replacement expected discards, so adjusted in response to the gap between the desired and the actual capital stock. So expected discards for simplicity are assumed to equal the actual discard rate. So the next one is the desired capacity. So desired capital is anchored to the current level, then adjusted up or down based on the expected profitability of the new investment. So in commodity market where individual producers are small relative to the industry, demand profitability is the shift determinant of investment in new capacity. So um, existing producers will expand and new players will also enter the market when the expected profitability of the new investment is high. So to sustain the low profitability leads to construction and exit. So of course, just as production pressures such as inventories, backlogs, and then the order rates may affect the utilization. So too, these direct indicators of demand may affect the decision to invest, particularly in concentrated industries with only a few major producers. So adding this feedback as an exercise, so this figure actually shows the generic model individual producers that assume to expand or contract their production capacity solely in response to their beliefs about the long-run profitability of the new capacity. So the desired capital is equals to the capital times the effect of expected profit on desired capacity. While effect of expected profit on desired capacity is equal to the function of the expected profitability of new investment. And then the expected profitability of new investment is equal to the difference of the expected long run price. So long run price and the expected production cost over the expected long run price. So expected profitability of new investment is the difference between the long run expected price and expected cost of the new capacity. So expected cost includes the normal return to capital investors require, so that when expected price will equal to the expected cost, the producers are earning the normal profit and are just content with the capital they currently have. And expected profitability is normalized by the expected price to provide a dimensionless ratio. So that's why the effect of expected profit on desired capacity is upward sloping. So the stepper of the effect of expected profit on desired capacity, the more responsive desired capital is to a given change in expected profit. So the responsive desired capital to expected profit around the equilibrium point depends on two main factors. So it depends. First, it depends on the responsiveness of individual producers and potential producers to expect profit. Second is it depends on the distribution of cost, prices, and expectations among the populations of producers and potential producers. The responsiveness of the desired capital to expected profit of individual producers and potential producers also depends on a variety of factors. So this includes the availability and reliability of the information about costs and prices needed to assess the profitability of new investment. Institutional and structural features of the market can affect the response as well, including um, access to financing and the scale of the investment required barriers to entry and exit, and adjustment costs such as startup and decommissioning costs. So the formulation of the desired capacity represents the aggregate action of all producers and potential producers in the market. So long-run price forecasts are formed by first-order adaptive expectation. So producers must be confident a change in price will persist long enough for investment today to be profitable when it comes online. The expected long run is equal to the smooth of the price and the time to adjust long run price expectations. Producers and investors must also form expectations regarding the cost of the new investment. So here, the expected production cost is equals to the smooth of the unit cost and the time to adjust expected cost. So the unit cost is equals to the unit variable cost plus the unit fixed cost. To expand and or enter the market, producers and potential producers must be able to marshal the various resources needed to invest. So these resources include financial backing and of course the technical know-how, the ability to assemble a qualified team to oversee the project, and of course the political connections and the social capital to grease the skids of site selection, the line of suppliers, and the win commitments from customers. The demand order rate for commodities can be modeled at various levels of detail. So a simple demand sector is sufficient for the purposes of the generic model developed here in the figure. So this is the demand sector figure. So the customer orders are modeled as the product of the underlying industry demand and the effect of other factors on demand. So the the industry demand is equals to the smooth of the indicated industry demand and then the demand adjustment delay. So the industry demand adjusts with a lag to the demand indicated by the price of the commodity. So in general, the delay may be of high order, but in simplicity, it is a first order response. So they indicated, so the equation here, which is the indicated industry demand is equal to the minimum of the maximum consumption, reference demand times the maximum of 0, 1 plus the demand curved slope and times the price minus the reference price and then over the reference in this industry demand. So, so the maximum functions, it ensures the demand does not fall below zero, that no matter how high the price is. And then the minimum function also ensures that demand remains less than a specified maximum no matter how low the price. So between these limits, the demand curve is linear. So the slope of the demand curve is chosen by the modeler by setting the elasticity of demand at the initial equilibrium. So the price setting process. Price setting offers one of the most difficult formulation chal- challenges in economic modeling. Prices of some goods and services are very stable, while others change from moment to moment. So there are also many different price setting situations. So first is the posted price system, where one party posts the negotiable price, the price tag on each item, while the seller posted price is the dominant pricing institution in retail sales. So example of these are some internet broker use buyer posted prices where buyers state the price they are willing to pay for an item and suppliers respond a yeah or nay. So a variant of posted prices is one-on-one haggling, where an individual buyer will negotiate with an individual seller. So usually, starting from a posted asking a price. So um, this practice or this system common in real estate and retail auto sale. So on the other end of the spectrum, uh, there are also various types of auction. So the most dramatic type is the open outcry double auction, in which multiple buyer and sellers call out bids and offer simultaneously, striking deals whenever they hear a bid or offer they like. Well, the double oral auction used in many commodity trading pits and stock market around the world. So the different price institutions provide a different information to the buyers and sellers, and of course involved in decision rules. So for example, in an English auction, so all bidders know the bids and often the identities of the rivals. So while in a sealed bid auction, they do not. So likewise, prices for many retail and industrial products are set by markup pricing, where the direct cost per item are marked up by a standard ratio to yield the least price. So store or product line managers have limited discretion to adjust prices in response to supply and demand or the competitor price. So here, the equation where P is formulated as an equilibrium price. So P is equals to equilibrium price times the function of the current demand and supply balance. So equilibrium price cannot be constant. So imagine that a permanent change in cost of production. So the equilibrium price will permanently change, but since the expected equilibrium price is fixed, so the market is forced into the permanent disequilibrium. So traders expected price, the level of price they will believe will clear the market, adjust gradually to the actual level of prices. So given traders expected price, how then are actual prices determined? So short-term pressures arising from imbalances of supply and demand or changes in cost or competitor prices will cause traders to bid prices up or down relative to their belief about the equilibrium price. That is, prices are set by anchoring an adjustment process in which cues move the price away from the anchor. So here, where the cues represent factors such as demand or supply balance, so unit cost, competitor price, and perhaps other that may cause traders to adjust their prices. prices setting process forms a hill climbing search procedure in which prices rise as long as demand exceeds supply and fall as long as there is exists capacity. So the hill climbing procedures, this enable the market makers to discover the market clearing price without having to know the preferences of the consumers or the cost structure of the producers. That is without having to know the supply and demand curves for the product and all the potential or actual substitutes. This figure shows that prices anchored on the trader's expected price, representing traders' belief about the market clearing price. So the actual price is adjusted up or down from the anchor in response to various pressures. So in this simple model, the adjustment arise from the demand or supply balance and traders' belief about the underlying cost of production. So price is equals to the trader's expected price times the effect of inventory coverage on price times the effect of cost on price. So here, traders believed about the underlying equilibrium price adjust to past prices. So first order adaptive expectations are assumed. So with a time constant given by the time to adjust expected price. So hence the minimum price is set to expected unit variable cost on cost of production. So price may fall temporarily below variable cost, but over the long run, the production will cease if producers cannot cover their operating cost. So prices are assumed to respond the balance of demand and supply without specifying how supply and demand are perceived by market participants. Producers are most concerned about the level of inventory they must store and finance, while consumers are concerned about the ability of sellers to make deliveries in full and on time. And inventory coverage is an excellent measure of both inventory carrying cost for producers and the ability of buyers to receive reliable, timely deliveries. So the prices are also assumed to respond to changes in traders' belief about the cost of the production relative to the expected equilibrium. So a simple and flexible function is given by the power of function y is equal to the exponential per exponent to where the exponent A, the sensitivity of price inventory coverage must be negative. So actually this is exponent A, so a typo error. So again, effective of inventory coverage on price is equal to the perceived inventory coverage over the reference inventory coverage, exponent of the sense of price to inventory coverage. The perceived coverage is modeled with first order smoothing. The coverage perception time would be short in markets with very good data or high sensitivity storage cost to inventory levels, and longer in markets with poor quality data or less sensitivity to storage costs. So this is the equation. So here, so if the sensitivity of price to cost is equal to 0, then the cost information is ignored in price setting. If sensitivity of price to cost is equals to 1, then traders' belief about equilibrium price are ignored and prices are anchored on expected cost instead. So this is the equation. So the behavior of the proposed formulation for price can be quite subtle. So consider the response of price to each change in expected production cost. So assuming that demand and supply remain in balance. So the system will always move exponentially to a new equilibrium in which price is equal to trader's expected price and equals to expected production cost. So here, change in trader's expected price is equal to the adjustment time over the adjustment time for the trader's expected time equals to the price minus the trader's expected price over the denotes to the time to adjust trader's expected price. So again, this is T exponential E. So sorry for the typo error. So the effect on cost on price where FC is equal to 1 plus the sensitivity of price to cost times the expected production cost over the trader's expected price minus 1. So this is I forgot to write or to type the asterisk here in sensitivity of price to cost. So in collect terms, change in trader's expected price is equal to the adjustment time over the adjustment time for trader's expected time, and then equal to the trader's expected price times the 1 plus the sensitivity of price to cost times here the expected production cost over the trader's expected price minus 1. So minus 1 close parenthesis divide the time to adjust the trader's expected price. So and so on. So here is the meaning of each equation here. So this figure shows that response of price to a change in cost. So the partial model test, so expected production cost double in year 1, while the time to adjust traders expected price is equal to, of course, 1 year, and then the sensitivity of price to cost is 0.5. So this figure shows that the weaker the impact of price on cost, the longer the adjustment will take. So another figure represents the partial model test. So before in year 1, the system is in equilibrium here. So in year 1, the relative inventory coverage is negative 1. Inventory coverage falls to 0.8. So the assumed sensitivity of price into inventory coverage is negative 1. So price immediately rises to 25%. So in year 3 to 5, the relative inventory coverage returns to normal. So the time to adjust the trader's expected price is equal to 1 year. Then the sensitivity of price to inventory coverage is equals to the -1. So traders gradually begin to revise their expectations about the underlying equilibrium price in the belief that higher prices will clear the market and restore inventory coverage to normal. But instead, as you can see in the figure, that the inventory shortage persists, so the actual price remained above the expected equilibrium price, and traders also continue to revise their beliefs about the level of price that will clear the market. So the expected equilibrium price chases its own tail in a positive. So as long as the inventory coverage remains less than normal, prices continue to rise exponentially. So as you can see also that in year 3, the expected in year 3, the relative inventory coverage suddenly returns to normal. So like what I've said earlier. So price immediately to the drop to the expected level. So note that however that the expected equilibrium price has now risen to more than 160. So um it is where costs have no impact on price, because price will remain at the new higher equilibrium until there is another imbalance in inventory. So traders have learned that the higher price is needed to clear the market and will only revise their beliefs if there is new evidence in this equilibrium at that certain price. So inventory coverage rises 40% above the normal at the start of year 5. So responding to the imbalance, traders immediately adjust the prices downward. So the market does not actually immediately clear, so their beliefs about the equilibrium price now begin to drop. But since the inventory coverage remains excessive, so that's why price remains lower than the expected equilibrium level, and traders reduce their estimate of the market clearing price and still more. So price or the expected equilibrium price decay exponentially. So as price continues to fall until the expected price drops to the limit imposed by unit variable cost. So to sum up, this model provides a formulation for the price discovery process that is robust, generates a rich array of behaviors, and is consistent with the principles of bounded rationality. So the two key formulations here is that price setting as an anchoring and adjustment process, and the adaptation of the anchor to past prices are also supported by the number of studies. So in econometric studies, routinely show that commodity prices responds to inventory coverage and the unit variable cost. So the application cycles in the pulp and paper industry. So in this figure, the industry is highly cyclical. So production, inventories, capacity, utilization, prices, and investment all exhibit a large amplitude cycle of about 3 to 5 years. So in inventory coverage, it fluctuates about greater than or equal to 20% around its average, while the capacity utilization average about 90% and moves comparatively little the over the cycle. So typically varying between 85 to 95%, and then the capacity exhibit almost no variations in the year 3 to 5 range, but does not exhibit longer. So capacity exhibits almost no no variation. So, but does not also it does not also exhibit longer, so slower movement. So the capacity, production, and investment have been detrended by plotting the ratio of output and capacity to the long run exponential growth trend. So here the capacity and the production. So both rose relative to the average growth rate fell sharply with the capacity and the production. So with the capacity and production declining relative to trend. So the growth trend between late 1940s to 1973. And then after 1973, the growth rate fell sharply with the capacity and the production declining relative to trend. So the roughly 60-year rise and fall of paper demand and capacity reflects the impact of the economic long wave. So a close look for the capacity data also reveals an intermediate cycle in capacity. So the cycle is most easily seen in the graph here in Canadian pulp capacity. So this is relative to the long run trend. So the capacity peak in 1975. So this generic model can be applied. Of course, this is an example of the pulp and paper industry without any structural changes. So on the demand side, Taylor found a demand elasticity of roughly zero point 0.5 with a 6-month adjustment delay. While on the supply side, the paper supply chain is long, progressing from logging through pulping. So the paper making, then finishing. So like for example, coating, drying, ruling, cutting, and packing, and finally into distribution channels. So the paper supply chain involves significant inventories of work in process and finish inventories. So this table shows the summarizes the parameters used to adapt the generic model to the pulp and paper industry. So the non-linear functions used for utilization and the effect of expected profit on desired capital are the same as shown in the figure of previous figure. So the capital productivity, so parameter value 1, and then units per year per capital unit. So the average life of capacity, the value of this is 20, so the unit is years, and so on and so forth. So the parameters for the paper industry model, the effect of expected markup on utilization and effect of expected profitability on investment are specified on the previous figure. So the model is initialized with the reference demand and price set to 100, representing 100% of their long run values. So this figure shows a simulation of the system with the approximate paper industry parameters. So this model is initialized in equilibrium. So at the start of year 1, a pulse is equal to 25% of the equilibrium demand is added to customer orders, causing an immediate drop of the inventory. So the response of the system shows two distinct oscillatory mode. First is that inventory, price, utilization, and production oscillate with a period a little less than 4 years. Second is that capacity oscillation with a period of about 14 years. So note that in this first graph, note that the phase lag between the inventory coverage and price. So the price is not actually simply the mirror image of inventory coverage, but rather price is rising when coverage is at its minimum and continues to rise for a little while even after the coverage begin to recover. So the phase lag is that apparently a consequence of the time required for traders to perceive changes in coverage and largely a consequence of the price discovery process in which prices tend to rise as long as inventory coverage is adequate. So, in conclusion or summary, the generic industry model is introduced several important and useful formulations, including price setting and response of investment to expected profitability. The model explains the origin of the chronic fluctuation observed in a wide range of commodity industries, and commodity cycles arise from the interaction of the physical delays in production and capacity acquisition with aboundedly rational decision making by individual producers and investors. So in the market economies, prices lies in the center a network of negative feedbacks which act to eliminate imbalances between demand and supply. And in many markets, the reactions of demand and supply to price are very slow. So that's the end of my report. Thank you very much.